Thanks for watching Inside Automotive with Jim Fitzpatrick.
Hey everyone, Jim Fitzpatrick. Welcome into another edition of Inside Automotive right here at the CBT Automotive Network. The Presidio Group has been very busy this year, advising on several major transactions across the country. Joining us in the studio now is George Karolis. You've seen him here before on CBT News. He's president of the Presidio Group to tell us more and also take a look at the recent Presidio NCM Average Dealership Performance Benchmark Data Report. Thank you, George, for joining us in the studio.
Thanks for having me, Jim.
Yeah,
good to be here.
Thank you for joining us. You're on like an incredible schedule because you guys just keep closing deals and working with dealers all over the country. So congrats on a great year.
Thanks. Busy year, but we're only a mile away, so we can.
That's right.
That's
on
my
right.
way to work.
You're one of the few
right.
clients that we have that's so close, right? We always see each other at lunch.
That's right.
Well, then you never buy me lunch, which I think is wrong. I think you should,
Yeah, I can't afford your
you
habits.
can't afford my hamburger. So tell us about the report.
Yeah, our partnership with NCM is truly incredible. We have data
fantastic
for
group.
over 4,000 dealerships that
Wow.
we report on quarterly. Generally pretty quickly within a few weeks of the quarter end.
That's
and,
nice.
Some interesting tidbits this year. Profits still trending higher year over year. Third quarter up on average about 7% overall profit-wise. But
Wow.
seeing some components of that, some kinks in the trends. Margins are still normalizing, and new vehicle margins down about 15%, right back in line with 2020 levels now.
Okay.
And so on the new side, some continued pressure in the normalization.
Right.
Used side, a little softer as well, but bright spot was F&I. F&I was up about 7% quarter to quarter, which is helping drive profits. And we see expenses coming down in a couple areas, floor plan and advertising. So
Wow.
Floor plan over 50% reduction in expense. So
Really?
I think some of that contributing to that profit increase.
Yeah.
With
Why do
F&I.
you think that we saw that? That have anything to do with maybe the clearing out of all the EVs?
Yeah, probably
or?
clearing out. Rates ticked down a little bit,
Right,
obviously,
yeah,
right?
yeah.
And then clearing out of EVs. Yeah, we
Sure.
had, this time last year, a lot more inventory.
Oh, yeah.
It was kind of up and down.
Yeah,
That's right.
Yeah, exactly. Do you think the OEMs have learned their lesson at all to say, let's keep this to maybe a 45-day?
No.
No, they just keep shipping them out.
Yeah,
right?
because are they in business to
I know,
not make
I know.
cars or
Bill-
make cars?
That's right. That's why it was always amazing to me why Tesla and Rivian wouldn't go the route of a franchise network, because they're able to just dump all that inventory on all of these entrepreneurs. They go,
right.
sure, we'll take your 500 cars, right?
Yeah.
Yeah.
I mean, I think dealers have gotten tighter on it and stronger.
Yeah.
I remember in the Great Recession, being at Asbury, and OEMs were trying to push everything on you. We had daily meetings on inventory management and what how to manage through that and not take vehicles. So I think dealers have a leg up on that now and aren't being forced to take vehicles. They can say no and know when to say no, but it's it's not perfect.
Yeah, yeah. Were there any numbers of the report that you found surprising, whether it was up or down?
Well, I think fixed operations is interesting. There's a lot of noise on the fixed side. Fixed continues to grow overall.
Yeah.
And you see a lot of strength in public company reporting this quarter on fixed. You see softer fixed with the privates this quarter on a overall gross profit percentage, but that's because the third quarter of last year is when the CDK was impacted in late June of 2024, and so a lot of private dealers, because they don't report on GAAP, just push those sales and that recording of sales and profitability into the third quarter of last year. So last year, private companies were up 12% from the fixed perspective, but that's because there was some pull forward from June of 24 into the third quarter of 24. And so you see a little softer number there. We have some data that we don't report, but anecdotally that RO counts are kind of flat. They're not really growing tremendously. Probably because there's a lot of pressure on cost. With labor rates increasing tremendously over the last couple of years, there's pressure on the consumer from a spending perspective and affordability perspective. And so it's really coming from price, not increased ROs, at least on the private side.
Do you think because of that, more consumers are really shopping around more than taking it to the selling dealer with the perception that
some
the
of that.
dealers charge more, it's going to take a little bit longer and...
Some of that, and some just deferring. If they can.
Right.
A little bit of that, but I mean, it's not significant or material. It's just a little bit like more anecdotal.
Right.
But fixed is still a bright spot. Publics are focusing on it tremendously. They're investing in it. Privates are investing in it. The technology that we're seeing is helping fuel that growth. Vehicles are more complex, harder to work on, and so that trend. Fixed will continue to be a bright spot and be around, if you will. But it's just there's more pressure on it from from inflation perspective.
Does the fact that a dealership have a large fleet of mobile service units play into the valuation of that store? Or is that there doesn't have too much to do with it?
Not significantly yet.
I
But
talked to one dealer. He's got 40 mobile vehicles.
Oh, look, I
on
think
the road.
mobile is.
Yeah.
I'm a big fan. We're big fans of mobile. It's the future. I'm only mobile. My good friend Eddie Stivers, Stivers Automotive Group.
Mobile.
I use their mobile. They service any vehicle.
Sure.
It is the most convenient, amazing thing, and they have it dialed in. And so I'd say the dealers that continue to focus on mobile, it's what the customer wants.
Right.
And once you try it, once you use it,
I know.
You don't want to go back. Now, like there's certain things that can't be done with mobile that you have to bring the vehicle in.
Right.
It's not really impacting valuation. Now, behind the scenes it might be, right? Because if your fix is growing from an outsized perspective because you have a great mobile service where you're growing your business and customers are flocking to that, then it's going to be in the numbers, which ultimately better numbers is better valuation. But I see that trend as a big trend go forward. Mobile, we'll see a lot more share there.
If I were a buyer out there of a dealership and they had a network already set up, they've got 20, 30, 40 trucks on the road, they've got the techs hired, they've got this thing all dialed in, that would be appealing to me to say, okay, these guys see the future and they're in it in a big way.
Definitely, definitely.
Yeah, interesting. So, and then of course, F&I income, where does that stand today?
F&I is a bright spot. We saw F&I increase almost 7% to over $1,660 a unit, $1,666.
Nice.
And so I think that's been also a driver of this 7% increase in overall profitability.
Okay.
So strong F&I.
And why the increase? Do you think in?
I think there's warranties are a little more expensive. Rate spread because rates came down actually makes the spread a little easier.
Yeah, I didn't think about that.
And just focus. Focus.
Right. Yeah, for sure. So let's jump into these multiple high-profile transactions that you've had. I mean, you've had a series of big, notable transactions. Talk to us about that.
Yeah, well, we've done 15 deals this year, transactions this year in our dealership and tech business, mostly dealership. But yeah, the last few months we've done a couple notable ones. In particular, we facilitated the sale of Fletcher, Jones, Mercedes, and Audi in Chicago, really large volume metro stores, to AutoNation, who has a presence in Chicago and has grown that presence. That's classic portfolio management, which we preach to dealers and our clients and friends around the industry. And so Fletcher Jones, most of their operation, they're an iconic brand, mostly in the West Coast, California, Las Vegas.
Drill down on that a little bit in terms of portfolio management. What does that mean to the dealer?
Sure. We see the publics in particular, and then the larger privates, and even the smaller and medium focus. That constantly now the best in class dealers now constantly evaluating their portfolio dealerships. Not every dealership works for every dealer.
Yeah.
And it could be a geographical issue. It just could be just not the right fit for a dealer.
Right.
It could be a management issue. It could be just a lack of desire to invest in that business or in CapEx. And so we see dealers regularly looking at their portfolio, and sometimes, even though they're growing and they're not necessarily sellers, pruning off stores.
Okay.
And our last 3 transactions actually were all large groups that are not sellers, that are overall net growers and trying to grow their business, sell stores off.
Okay. And using that capital to then throw in
redeploy the capital. And typically it's not a capital issue as much as it's a portfolio optimization issue. Really resources, and so you don't have unlimited personnel resources and human resources. So and sometimes it's the 80-20 rule. Sometimes some of your hardest stores are taking up 80% of your time, and you want it to be the reverse.
That's right.
So that's another reason. And then also we see publics and large privates. Oftentimes when they make acquisitions, they might hit a cap. Particularly, we see a couple of the publics. We did a deal for Asbury a couple of years ago where we helped them sell a Lexus store that they purchased from the Coons acquisition because they hit a cap.
Okay.
And so they had to sell a store. And so you'll see it for that reason as well.
That's got to bring you to tears when you got to sell a Lexus store, right?
It's Lexus.
It's not a good day.
In our survey that we do twice a year, Lexus continue to be right at the top.
Yeah,
Lexus
absolutely.
and Toyota.
Right. Yeah.
That's right.
Yeah. So also Stivers right here in Atlanta, our hometown.
That's right.
Right. That's a big deal.
Stivers Subaru, in Decatur, really large, tremendously, tremendous store.
Yeah.
But Stivers, Eddie and his family, they're focused on Ford and Hyundai and other brands, and this was a strategic a sale for them to optimize their portfolio. They've bought a few Ford stores just here in the last year or so, and so it was a great deal. Lithia is trying to grow in the market, and they were the natural buyer and stepped in and are now the stewards of that store.
Yeah, that's nice. They've got some stores in South Carolina as well, right?
That's right. Yeah. And our most recent deal we closed last week was actually for the Hendrick Automotive Group, one of the largest privates in the country. Hendrick's, again, you would think, oh, they don't sell stores. Well, they had a Honda store in a market where they don't have a big presence. It wasn't working for them, and they decided strategically to sell the deal.
Okay.
And the Orsman family, through the Graham Orsman partnership, Chris Orsman, they had stores right there, Toyota and Chrysler, right in the market.
Yeah,
and so it was a natural fit for them, and it was a kind of a one-on-one deal, sort of a match deal.
Sure. I asked this of your colleagues in the industry, is it a buyer's market or a seller's market right now?
It's definitely still a seller's market.
Yeah.
And it has been, since the pandemic and a little bit before the pandemic.
Sure.
It's definitely still a seller's market. We're seeing record demand still from buyers, more buyers than sellers. Now, of course, we preach this, right? Brand geography are more important than ever, but also deals have to be rational. And the last few years, in particular, a couple of years right coming out of COVID, we like to refer to it as the gold rush. Right. It brought in a lot of new buyers, but it also brought in a lot of advisors. And we see oftentimes some dealers having incorrect expectations about the value of their business. Okay. And some folks telling dealers what they want to hear in terms of what their business is worth. Those deals are tougher to get done, right? Okay. We call that the bid-ask spread. So if it's a rational deal and the seller has a rational expectation of value, right, then it's a seller's market because there's going to be demand by buyers. Right. And of great value, but not outside the lines, if you will. And so that has to be rational.
We were talking before we got recording today that you've got some pretty cool ways now to really hone in on what the value of a specific dealership is. So when somebody calls you and says, hey man, I'm sitting on a, whatever it is, a Chrysler store or a Dodge, or Toyota or Nissan or whatever the case might be, can you give me an idea of what this is worth? And you got you can pretty much dial it in today, right?
Well, we were having fun talking about a little valuation tool we created that's a little more for fun, but we have a pretty dialed in process. It's pretty sophisticated and it's intense. We won't actually engage with it on either the sell side or the buy side with anyone unless we're on the same page with our clients in terms of what value is. And so we always do valuations and give a sense of what the value is. And there's a lot that goes into it. Sure. 100 years of expertise with our team members, a lot of robust database full of information about what stores, overall around the country, but then in certain regions are worth, and we'll and really it's about what the expected cash flows are. Right. So you have to. I think we talk about this. I think I said this in our report that we recently released, that there's not one dealer financial statement that is ever completely accurate when you go to market. There's always adjustments that have to be made one way or the other, right? And so. And then take that, multiply it, take that forward, and then it's what opportunities are there, what the store, how should the store be performing? Right. And so every deal is unique, and there's numerous concepts and numerous sort of levers that go into valuing the dealership, and you want to do that up front. You never want to go to market with an expectation that you're not aligned with a seller. Right. Because if you do, then nobody wins, right? A deal ultimately doesn't get done. So the deals that are not in alignment, where there's an improper or unrealistic expectation of value, those are going to be under pressure. We've seen a couple of those recently. Not our deals, but just out in the market as we help other clients. Sometimes deals just don't make sense. Folks are asking for too much, but in the main, if it's valued properly, and again, it's a seller's market, deals are getting done.
Right, and if a dealer acquired a store in 2021 after COVID, or 2022, and they paid those huge telephone numbers, and they want to get out of the store, it's almost like trading your car. Well, at that point in time, sort of. Man, I got $40 million in this store. You're telling me it's worth 30. Or I
actually think a lot of those are exceptions and outliers. Okay. Most of the deals we did during that period, none were valued off of peak earnings. Okay. The complexity then was, how do you figure out what normalized earnings, what the the real earnings are going to be of this business go forward.
Right.
And it was never off that peak in 21 or 22.
Yeah.
And there were a lot of different scenarios and folks saying, well, we're going to take the average of pre-COVID and post-COVID, we're going to take the 4-year average. I mean, it was difficult, but most deals were not valued off of peak earnings, right? So there was an expectation, just like the public companies, if you looked at their trading multiples during that period of time, they were trading, well below where they're trading today from an EV to EBITDA, from an earnings to EBITDA perspective, PE. Because the markets are pretty sophisticated, they knew that hey, these earnings levels aren't going to be sustainable. So their multiples looked different. Their earnings were great. Their values were tremendous. Their enterprise value was still great. So that's how private deals really were acting then. But there were some outliers, and in particular, some of the brands that are really struggling today. That's probably what you're talking about. So we don't need to name those brands.
We've now been talking for 15, 20 minutes, and neither one of us have used the T word, tariffs. Are we not talking as much about that in the industry, especially in this segment here, in terms of the buy-sell market? Is that just not a factor anymore, or what?
Not really. I mean, it's a small factor in terms of some of the brand preferences.
Okay.
So you see some. So you see it anecdotally with, but not in your face anymore.
Right.
We just had our third annual Auto Tech Conference, Presidio Auto Tech Summit in Denver, which was sold out last week.
I heard it was incredible.
And we actually, after the conference, there was about 150 people there. We were debriefing, and we said, we didn't talk about tariffs once in this entire conference. Same thing. Didn't come up once.
Isn't that crazy?
It's all about AI and technology. And
you go back a year, or you go back 8 months or whatever, to be like, oh my God, the industry's over. Forget it.
Just like the internet.
That's right. We did. Talking, I've brought this up a number of times when we talked to Senator Bernie Moreno, as you know, is a car dealer, and he said, this is a blip on the radar. In a year, we won't even be just talking about this, and maybe he's right. In a year, we won't even be talking about it.
That's right. And we're going to have Senator Moreno at our Auto Team America annual conference in Las Vegas.
Oh, very cool.
In February, at the Wynn Hotel.
Yeah,
so hopefully
everyone,
all the viewers can come join that. He'll be there among a lot of other great folks. So he's amazing to listen to. He's really dialed in. If you want to really know what the government's thinking, he'll talk about it as much as he can.
And it's so good that we have a car person, a car guy, or so to speak, at the table now.
That's right.
And right there in the thick of things, helping us through all of this. So. We need more. We need more Bernie Morenos running for office, right? But
scary thing to do, though. It's a
I know.
tough environment.
So talk to me about the future. What is the rest of the year look like with regard to M&A, and then what does the first quarter or beyond look like in 2026?
Yeah, our year will end pretty strong. We've got several closings scheduled for the next 2 months. Well into mid-December. Once you get past mid-December, the OEMs sort of go on vacation.
Right.
But so we'll see 4 or 5 deals close in our business during that period, and our pipeline into the first quarter is stronger than it's ever been. So it's probably a record pipeline. So we're going to see a lot of deals, at least from our perspective, transpire in the first quarter. And I expect that to continue throughout. Well into next year and actually into future years. This, again, whether it's a seller's market or buyer's market, the demand from dealers for assets and to grow is there. We're going to see consolidation. We expect to see consolidation for years to come.
Okay. The future of the mom and pop, I have 1 or 2 stores. Will it just continue to be increasingly more difficult for me to operate my stores because of the consolidation out there? Or not so much?
Somewhat. It depends on the geography, right? If you're in more rural areas and you have less competition, perhaps not. And it's a community business.
Family
in
run.
Larger metros, it gets a little tougher.
Yeah.
Costs continue to increase. Competition's strong. Yeah. Every metro's different. Every market's different. But the investment required as AI is coming into the business and technology comes into the business. Facility demands keep changing. They always do.
Of course.
It's a pressure on investment, and look, it's expensive to renovate. Dealerships today. The cost of building is at record levels, and there's not much end in sight to that.
That's right. That's right.
It's cross board.
Any comments on Nissan, and then the follow-up's going to be your feeling on Stellantis stores?
Yeah, I mean, both. We're seeing some positivity. We're seeing a little drumbeat from private dealers more so, which are a little bit more longer-term focused. taking shots at Nissan and Chrysler, thinking they bottomed out, thinking they've made some good changes management-wise, product-wise. Chrysler's going to lag that on the product perspective, but we're actually seeing a little bit more positivity in both brands, and dealers actually asking about them, and some even saying, hey, I'm looking for Stellantis dealerships, I'm looking for Nissan dealerships. So we're seeing that a lot more than we did last year.
You think they've turned the corner in both cases?
I don't know if they turned the corner per se, but we're seeing dealers, and dealers are smart folks, and so from a risk-adjusted perspective, earnings are lower on these businesses now. So from an overall valuation, because again, it's all about earnings. People talk too much about multiples. Most of the equation is about earnings. And so as you apply, the earnings component to value, there are some deals there now in some of these businesses, and so we're seeing more demand.
Great. So dealers, if you're Nissan and you're Stellantis and you're thinking about maybe this is the year, right? Call
you. or maybe you'll start making more money.
Oh, that's right. That's right. I was sorry to see I can't remember the gentleman's name, and forgive me for that. I interviewed him, but the guy that took over for Nissan for sales and marketing, he came from Toyota, great guy, and then he left the industry.
That's right. Yeah, he's down to telecom.
Yeah. So. Because I think a lot of people were feeling as though, hey, this guy's got.
Yeah, Jason Stein had him on stage at the J.D. Power. Am I allowed to talk about that J.D. Power conference in New York last year? You were there. That's right.
That's right.
And he was pretty impressive on stage.
Yeah, he was. Yeah, good guy. But that's the auto industry, right?
Right.
So, any final comments that you want to share with the dealers about the industry or your forecast? I guess you just really touched on all things are looking good for.
Yeah, look, I'm not here to give advice to dealers. They're better operators than I am.
Wait a minute, you're an advisor. They want advice.
I'm an advisor. I can give them a lot of advice on the value of their business.
Okay, there you go.
They can tell me how to run a deal.
That's
but
right.
I think dealers are incredible entrepreneurs, and there's so many of them in the business, and we're really excited to see. We kind of feel like this is still a golden age for the dealership business. Folks are loving personal transportation, and technology is only helping. Because it's not hurting it.
For sure. And we didn't touch on affordability. That still continues to be kind of a pain point in the industry.
Yeah, average price in September over $50,000 from some of the data we saw. There's different data out there.
Right.
And there's pressure on the consumer.
Yeah, it really is.
And hopefully we'll see rates tick down some more.
Right.
But it's wallets are being stretched.
Yeah, it's crazy. George Karolis, president of Presidio Group. Thanks so much, man, for stopping by. And
Thanks.
You're right around the corner, so I don't know why you're not in here more.
All right, let's have lunch next week.
There you go. It's on you.
Done. Thanks for having me.
Thanks.
Thanks for watching Inside Automotive with Jim Fitzpatrick.